So in the markets right now, 2.4 on the 10-year. Bill Gross says, oh, now we're going to be in a bear market. What does David Solomon of Goldman Sachs say?
Look, markets are reacting pretty well at the moment. We've got pretty good economic growth all over the world. And actually, if you step back and you think about 12 months ago, the expectation for growth was not as strong as growth's actually come in. So the US doing pretty well, Europe doing pretty well, Japan even doing a little bit better. We're in an economic environment at the moment where the economy is really helping to propel markets. And with the significant amount of monetary policy that's still in place, that's leaving people to continue to invest and shift money into markets. And that's a delicate balance. But
then there's some concerns. David Costin, who leads equity research over at Goldman Sachs, had a really great note out. He said clients keep asking him all the time, when will the rally run out of steam? What do your clients ask you about that?
Well, our clients certainly are interested in our perspective on markets. And one of the things, to remember when you think about markets, there's no question it's been quite a rally, but you could go back and you could look at 1997, as a data point.
And do you want to compare yourself to 1997?
Well, I don't want to compare to 1997, but just from a market data point, you go, look, a lot of the sentiment that people had about markets then is similar to some of the sentiment today, and yet the market ran, for a period of time. Equity markets ran for a period of time. Look, it's an interesting time because you have kind of this base of solid economic growth, but there's no question the cycle's been running for a long time. So I think you have to be invested, but you have to invest cautiously.
So a client comes to you and they say, I want to do this deal, but this worries me. The fact that we're at 2.4, the fact that the Fed may raise rates, the fact that we're at all-time equity highs, we might have a downturn. What do you tell them?
Well, it depends on what kind of client you're talking to and you're looking at. If you're talking to a client that's looking to do something strategically, strategic transactions that really are transformative or significant for companies, are made with a long-term view, with a long-term thought process. They're generally not affected by short-term market activity. And so, a big corporate that's looking at something strategic, you're thinking about a bunch of broader issues and giving advice around that transaction. If it's a capital raising, if you're a company that's in need of capital, you have refinancing needs that are coming up, I think the advice at this point in time is get it done. The markets are quite receptive. Get that stuff done, because you don't know whether or not the markets are going to continue to be as receptive as
So if you're saying get that done, does that mean that Goldman thinks that we're going to be in a higher rate environment, more of a hawkish Fed environment?
Well, get that done means that you have a very inviting market right now for financing activity and the variety of things that could make the environment less inviting, at some other point in time. With respect to the interest rate environment going forward, there's no question that if you look forward, we're going to be in an environment where this monetary policy that's been in place is going to unwind. The question is not if, the question is just when, how, what's the process. So yes, I think over time there's going to be a bias toward higher rates, but how that happens and how it unfolds, yet to be seen.
So how does Goldman Sachs and your clients then wind up thinking about who's going to be the next Fed chair? Because we play it like it's a lottery. We're on it every day as the media. How do you guys think about it?
Well, look, there's certainly a lot of interest in who the next Fed chair is going to be. Very, very important decision for the president to make. There are a lot of, very, very, qualified candidates that are being considered. And look, this Fed chair is going to play an important leadership role in, helping the markets deal with the unwind of this monetary policy that's been in place for a period of time. So I don't have a, a view on.
You do. You just won't tell me.
Well, I don't have a view on this candidate or that candidate, but an important job, and clearly, someone that's going to be in a leadership position to, to affect, the unwind of this monetary policy over time, depending on what market environment we have. Clients are asking about that, but they're also, they're focused on tax reform.
Right.
They're focused on what's going on with economic growth around the world. They're focused on regulation. So it's part of the discussion with clients. But, then again, it's one of a number of topics. And, we'll watch, as everybody does, to see how that plays out in the coming weeks.
So we'll get to the clients in terms of deregulation and tax reform in a second, but I just wanted to pivot on the Fed for a minute, talking about your value at risk. So VAR, it's right at its lowest since 2002. So if I take a look at VAR, take a look at capital returns, I take a look at your head count, it feels like Goldman's positioning for a turn in the market, maybe taking risk off the table.
VAR is a reflection of activity going on all over the firm, and one of the things that our, the members of our team all over the world do, they're talking to clients and they're responding to the market environment that's given to them. What do clients want to do? What do clients want to transact in? What kind of activity are clients generating? One of the reasons why our VAR is lower is because the opportunity set that our clients are providing us with is not as high, it's not as robust. You've certainly...
But Morgan Stanley's isn't. So that makes me think that you are positioning for some kind of move.
Yeah, I think that our VAR is a reflection of the activity and the interactions we're having with our clients. And if you look at our franchise, the way our franchise is facing clients, I can't comment on Morgan Stanley or what's going on in terms of their activity, but we're responding to our client needs and our client activity, and that drives, what's on our balance sheet and what our risk position looks like.
Would you say that you're more tilted to safety or risk?
I'd say that we're tilted towards interacting with our clients and intermediating for them. And there's no question that our VAR is operating at a lower level, but that's a reflection of what our clients want to do with us and the market opportunities that we see at this point in time.
So in September, you had a presentation, and you said that in your FIC business, you had some lateral hires, and you really emphasized Europe. What opportunities do you see in Europe?
So, Europe's very interesting at the moment because there's no question the economic growth and the economic activity there has surprised to the upside, and that's leading to both more market activity and more investing activity and also more corporate activity as those businesses in Europe are feeling a little stronger, a little more confident, a little bit more of a tailwind. And so there are places in our business where we see opportunities to invest a little bit more to be better positioned to serve our clients, and those comments reflected our focus on doing that.
So specifically where? Because you kept making the case that you're going to get more prime brokerage accounts. Certain competitors are struggling in that area. I'm assuming that you gain market share there. Do you feel like that's sustainable? Can you add more?
Yeah, I think there are definitely places where we can add market share. And one of the things from when you talk to Harvey about our growth initiatives is a portion of our growth initiatives that's focused on places where we see market share opportunity, both in FIC and in equities, where we see client gaps or places whereby adding resources or focusing more on certain clients, we think we can take market share. So yes, we have strong market share across Europe in all of our businesses. We have good market share in our banking business. We have good market share in our sales and trading equity business and also in our investment management business. But there are places where we actually can invest and improve our market share and improve our position. And as an organization, as a leadership group across the organization, we're very focused on making those investments and making sure we're creating growth opportunities.
Is that FIC and equities?
It's not just FIC and equities, it's in banking too. And so, one of the things in banking that we've looked at is we have broad market share and a broad footprint, but there are also places where we can grow that footprint. And so as market cap expands, there are more companies that might have been under the radar screen that suddenly are billion-dollar type companies, and so we're looking at our footprint there. And obviously in our investment management business, we continue to invest in that business and the private wealth business, and there are good opportunities there for us to continue to grow our market share.
Any specific regions in Europe, or is it just broad?
It's broadly across Europe.
So you brought up lending, so let's touch on that just a moment. So you unveiled this really good plan. It seems like you're really focused on that. Analysts are looking forward to how they judge it. If I'm a market participant and I want to look at Goldman and say, are you delivering on those promises in terms of your lending business and really growing it? What do I look at?
So there are different things that you can look at if you step back and think about our lending business. Lending is a broad term, and it touches lots of activities that we engage in with our clients. On one hand, we've made a very, very significant push over the last few years to broaden our debt capital markets capability, and we've significantly improved our market share in debt capital markets. In fact, if you look this year at our performance, our 9-month debt capital markets underwriting activity is a record for the firm. That comes with focus over a period of time, but that's a form of lending. We've got corporate clients that are making acquisitions, are looking to purchase companies in the market. We're committing capital, we're lending into them in order to support that business. And so that's one example of that.
So it's revenue. So that means revenue. We have to look at revenue in that business.
Revenue is a metric in that business. Revenue is a metric. One of the things that I know you're aware of is we've started over the course of the last year, we launched about a year ago, a consumer platform, which is a new area of expansion for us, Marcus by Goldman Sachs. And this is a business where customers who have credit card debt can manage that credit card debt more effectively with a fixed rate, no fee loan. And so we're very excited about the product. We've been rolling that product out. We're in the early stage. We're on track to have about $2 billion of loans in that business this year. But over time, that's a business that we think could be a nice business and a nice contributor to the firm, and there'll be more information available on the growth of that business and the trajectory of that business as that business progresses.
Before I let you go, I want to ask you about capital ratios. The gold-plated, 5 to 6%, that's what we have in the U.S. We talked about regulation briefly in terms of what your clients are looking at. Does it get rolled back to 3%? What's your base case?
Our base case is we're operating with the regulatory environment that we have today, and we're always we have to operate in the environment that we have today. I think one of the things that's interesting about the environment that we're in is you had all this regulation that came in to promote safety and soundness in the system. And one of the resulting impacts of that is there were a whole bunch of rules that were put in place. We're now 8 years past the financial crisis. It's okay to kind of look back and say, okay, what are some of the unintended consequences? How is this slowing economic growth? How is this changing capital allocation in ways that really isn't to the benefit of the system? And I think people are now talking about that stuff, starting to review that, starting to think about ways that the overall process can be improved, and I think that's a very positive or healthy thing. And so we're watching that like
that's a yes.
Else.
Capital ratios, yes.
We're watching that like everybody else.
Are you looking at spending more time in Frankfurt?
You know, Lloyd was in Germany last week. He had a very
I gotta say, because most people don't want to spend more time in Frankfurt. I gotta say, David.
Well, we've got a lot of good clients throughout Germany, and I actually like spending time in Germany.
You do?
So
really?
I do like spending time in Germany, but I like spending time in France, and I like spending time in Italy, and I like spending time in London too, which is going to continue to be a hugely important center for us. We have you know, an enormous investment in London, and that's going to continue. But there's no question, you know, we've got people in Frankfurt. We're going to have some more people in Frankfurt, and we've got people spread out across the continent. And candidly, I like spending time in all of those places. I think they're great places to visit.